Hello traders and welcome back to the new video of Nova Forex. As we all know that the smart money creates the liquidity zone to trap the retail traders by hitting their stop loss in the market. So, in this video we would share the best liquidity trading strategy that would save you from getting into these traps and making up a profitable trade. But before we start the video, make sure that you subscribe to our channel and hit this bell icon to never miss our exciting content. The liquidity simply means big money. As we all know that for every buyer a seller is needed who can sell those shares, and for every seller a buyer is needed who can buy those shares. When the smart money wants to enter the market, they manipulate the price and increase the liquidity to induce the retail traders into the market. Let us understand this with an example. Let us assume that a central bank wants to buy 10 million shares of the euro-pound currency pair. They would not randomly initiate their buy position at any point of time in the market. They would not enter the market when there is low liquidity in the market, because if they do so, all their orders would not be fulfilled because the price will rapidly move upwards. And thus, they would create high liquidity in order to buy at a low price. Now a question might arise in your mind about how to identify the liquidity zones. So, basically the liquidity zones are the areas where a lot of the retail traders initiates their buy or sell position. Let us understand this with an example. Here we have the pound-yen on 1 hour time frame. So, as you can see here that the price rejected this support level 2 times, which is why the retail trader would initiate their buy trade once the price reaches again to the zone. Let us see what happens if they initiated their buy trade here. The price hits their stop loss and comes to this bullish order block zone and then rapidly moves upside. Let us see one more example of this. Here we have the euro-yen chart on 1 hour time frame. So, we can see price respecting this trend line 2 times. And thus, when the price comes back to this level, the retail traders would initiate their buy trade in the market. And below the trend line, we have a bullish order block zone. Let us see what happens. So, as you can see here that the price hits the stop loss of the retail traders and then grabbed all its liquidity and moved upwards. If the price creates a liquidity zone after the creation of the order block zones, then the price has a higher probability of returning back to the zone and then continuing its existing trend. Let us see an example of it. Here we have the USD pound chart on 1 hour time frame. So, here we have an uptrend as the price is continuously breaking its structure to the upside. And then we see market forming an imbalance candle after the break of structure. And thus, we would plot the bullish order block zone which formed before the imbalance candle. And then we see market forming a liquidity zone as it created equal lows. So, the retail trader would initiate their buy trade once the price again reaches back to this support level. But their trades ended up in hitting their stop loss and then reaching to their target zone. The smart money manipulates the price and brings back to the zone because they need sellers in the market as they want to buy the currency pair at a low price in the market. Let us see one more example of this to make sure that you understood it properly. Here we have the USD yen chart on 1 hour time frame. So, here we have a downtrend as the price is continuously breaking its recent lower low to the downside. And then we see price forming a big bearish imbalance candle after the break of structure. And which is why we would plot a bearish order block zone from the previous candle which formed before the imbalance candle. We can see price rapidly moving away from the bearish order block zone. And then, we can see price forming a liquidity zone. And which is why the retail traders would initiate their short trade when the price again reaches to this point, because the price rejected this point 2 times. But their trade hits the stop loss. After which the market grabbed all its liquidity at the bearish order block zone and then continued moving downside. Now let us learn about the types of liquidity. There are too many types of liquidity, but we would focus on 2 types only, which is equal highs and equal lows, because most of the market forms such type of liquidity only. So let us see some of the examples of these two types of liquidity. Here we have the euro-pound chart on 1 hour time frame. We can see market doing the break of structure to the upside, which indicates that the market is in an uptrend. We can see that the market made an inefficient candle here, which is why we would plot the bullish order block zone from this point. Then the market formed a liquidity zone of equal lows. Now we would wait for the price to reach back to the bullish order block zone in order to initiate a buy trade. Here is our entry point. And as you can see that we made a nice 4:1 risk to reward ratio through this trade. Let us now move to another example. Here we have the USD pound chart on 1 hour time frame. So, here we have a downtrend as the market is continuously doing the break of structure to the downside. We can see market forming an inefficient candle after the break of structure. And then we see market forming a liquidity zone of equal highs. So, the retail traders would initiate their short trade once the price reaches to this zone again, because this zone provided a resistance level to the price before. The price reached at this point, and which is why the retail traders would initiate their short trade at this point. Let us see what happens next. The price hits the stop loss of retail traders, and then the market grabbed all its liquidity and then moved to downside. The smart money makes this liquidity pool in order to trap the retail traders, as they need sellers in the market to buy the currency pair or vice versa. The impatient retail traders often fall into this type of traps that are set by the smart money. Now that we have learned the basics of the liquidity concepts, let us move to the strategy of liquidity. Here we have the Euro-USD chart on 1 hour time frame. The first step in our strategy is to identify the trend. We can see price doing the break of structure to the upside, which indicates that the market is in an uptrend. The second step in our strategy is to identify a liquidity zone. Our aim with this strategy is to enter into the market when the market sweeps its liquidity zone by grabbing all its liquidity. We can see price going into the liquidity zone of equal lows and trendline. This is a trap which is set by smart money, as most of the traders would initiate their buy trade once the price reaches back to these equal lows zone, which provided support to the price earlier. Now that we have identified the liquidity zone in the market, we would wait for the smart money to manipulate the market by grabbing all this liquidity. We can see price hitting the stop loss of the early buyers and then coming to this zone. We would initiate our buy trade from this point. We would keep our stop loss below this liquidity grab candle and place our target 3 times the stop loss. And as you can see that we ended making up a profitable trade. Now let us see one more example of this strategy in order to make sure that you understood this strategy properly. Here we have the Euro-New Zealand dollar chart on hourly time frame. So, first of all, we would identify the trend of the market. We can see price doing the break of structure to the downside, which indicates that the market is in a downtrend. Now we would wait for the price to go into the liquidity zone. Here we see market going into the liquidity zone of equal highs and the trend line below it. This is a trap which is set for the retail traders, as they would initiate their short trades in the market once the price reaches to this zone, as it provided resistance to the price before. But we would initiate our short trade only when the price sweeps the liquidity zone. We can see price sweeping the liquidity zone, and which is why we would initiate our short trade when the market makes a liquidity grab candle like this. We would keep our stop loss above the wick of this candle and place our targets at 3 times the stop loss. And as you can see that we ended making up a profitable trade. This brings us to the end of this video. So, in this video we learned about the basics of the liquidity zone. And after it we learned about the best strategy that you can use while trading in order to maximize your profits by entering into the smart money entry areas. We also learned about how the smart money traps the retail traders by creating a liquidity zone in the market. Most of the impatient retail traders fall into this trap, which is created by the central banks and the financial institutions. If you found this video interesting, then don't forget to like the video. And make sure that you subscribe to our channel and hit this bell icon as we upload new smart money trading strategy videos every week. See you in the next video.